Imagine earning a hard-earned consulting fee abroad, only to realize you've got to pay tax on it twice, once over there and then again right here in India. Ouch, right? Well, hello and welcome to this explainer. As tax professionals, chartered accountants, and students, keeping up with legislative overhauls is just part of the job. Today, we are focusing on a really critical area of international taxation under the newly introduced Income Tax Act 2025. Specifically, we're going to break down Chapter IB, which provides the legal framework for double taxation relief. All right, here's our roadmap for today. We'll quickly look at the core problem, break down the new legal provisions under Sections 159 and 160, walk through a highly practical example, and then tackle the mandatory compliance forms. After that, we'll discuss common issues in MAP, and finally, wrap it all up with a summary. Let's get right into it. Starting off with Part 1. The core problem we are trying to solve here, double taxation. Okay, let's dive into this. What exactly happens if you earn income abroad, but you live in India? Do you literally pay tax twice? Look, it's a universal pain point for global earners and businesses. If you're an Indian resident, your global income is generally taxable here in India. But obviously, that same income might also be taxed in the source country where you actually earned it. Without a proper relief mechanism in place, international trade and cross-border mobility would just grind to a halt under the crushing burden of double taxation. And that is exactly where Chapter IXB comes to the rescue. This is the statutory solution within the new Income Tax Act 2025, specifically designed to provide relief from this double tax trap. It essentially modernizes the older framework, streamlining the language and the procedural requirements, while keeping the core principles of international tax treaties and unilateral relief totally intact. Moving on to Part 2, the actual legal provisions. Let's look at Sections 159 and 160. Now, for all the seasoned CAs and tax pros watching, let's build a bridge from what you already know from the 1961 Act over to the 2025 Act. It's vital to get this mapping right. The old Sections 90 and 90A, which dealt with bilateral agreements, those now map directly to the brand new Section 159. Meanwhile, the old Section 91 for unilateral relief, that's now governed by Section 160. Getting this direct transition clear in your head is step one. So what's the core distinction between the two under the new law? It's pretty straightforward, really. Section 159 is all about bilateral relief. It kicks in when India actually has a double taxation avoidance agreement, or a DTAA, with the other country. Under 159, the provisions of the Act applied to the extent they are more beneficial to the taxpayer. On the flip side, Section 160 provides unilateral relief. Think of this as your statutory safety net. It's for Indian residents who earn income in a country that India does not have a DTAA with. It ensures they still get credit for those foreign taxes paid. Okay, let's jump into Part 3, a practical example. Because theory is great, but how does this actually work when you're crunching the numbers? Let's put Section 16 into practice. Imagine your client, an Indian resident, earns income in a non-DTAA country. How do we rescue them from double taxation? Here is your step-by-step. Step 1. Compute their global income, including those foreign earnings, under standard Indian tax provisions. Step 2. Determine the foreign tax they actually paid, by deduction or otherwise, over in that foreign country. Step 3. Apply the deduction from the Indian income tax payable. Now, the absolute golden rule here is that relief is calculated at the lower of the two rates, either the Indian rate of tax or the foreign rate. And hey, if both rates happen to be exactly equal, relief is just granted at the Indian rate. It's a fairly straightforward but absolutely vital calculation to get right. Which brings us to Part 4, compliance and mandatory forms. Because knowing the law is only half the battle, right? You have to file it correctly. Under the new Income Tax Rules 2026, the compliance forms have gotten a bit of a facelift, and they've been renumbered. The essential ones you really need to master for Chapter 9B are Form 41, Form 42, Form 44, and Form 55. And oh, here's a massive systemic change you're going to love. Across all these forms, those old headache-inducing concepts of assessment year and previous year have been completely tossed out. They are replaced by a single unified tax year. Honestly, that's a huge win for everyone's sanity. Now, I really want you to pay close attention to Form 44, which is prescribed under Rule 76. This right here is your golden key. It is the mandatory form filed by a resident assessee to actually claim the foreign tax credit, or FTC, for taxes paid outside India. Listen, whether your client paid taxes abroad under Section 159 or 160, you absolutely must file Form 44 for the relevant tax year. If you don't, you simply don't unlock that credit on their return. It's that simple. Next up, it is super crucial for practitioners not to mix up the inbound and outbound paperwork. It happens more than you'd think. Form 42 is an application filed by Indian residents to get a tax residency certificate, or TRC, from our income tax department. This is what helps them claim treaty benefits in other countries. Conversely, Form 41 is filed by non-residents who are receiving income from India, and they want to claim DTAA benefits to lower their withholding taxes right here in India. So to keep it simple, Form 42 is your outbound proof, and Form 41 is your inbound proof. All right, Part 5, Common Issues in a Map. This is where you really prove your value as a tax professional by resolving disputes. In the real world, we see a few major pitfalls that can literally cost clients big time. First off, failing to obtain a TRC using Form 42, well, foreign authorities might just outright deny your treaty benefits without it. Second, incorrectly calculating the foreign tax credit, or heaven forbid, simply forgetting to file Form 44 will lead to an immediate demand notice here in India, and nobody wants to make that phone call to a client. Finally, taxpayers sometimes face really aggressive taxation by a foreign authority that completely contradict the agreed DTAA provisions. So the million-dollar question is, what do you do when those treaty benefits are wrongly denied or disputed by a foreign country? You escalate. Enter the Mutual Agreement Procedure, or MAP. This is a brilliant alternate dispute mechanism where the Indian competent authority and the foreign tax authority sit down and negotiate directly to resolve the issue. It is your ultimate escalation path to ensure your client gets consistent tax treatment and international tax certainty. And how exactly do you trigger MAP? An Indian resident must file Form 55 under Rule 121. For the veteran professionals tuning in, you'll remember this as the old Form 34F. You file Form 55 when you're aggrieved by a foreign tax authority's action that violates the DTAA under Section 159. Filing this formally petitions the Indian government to step in and bat for your client at the negotiation table. Finally, Part 6, the summary. Let's bring all these concepts together. Just a quick final reminder on that crucial terminology update for all your 2026 filings, the shift to a single tax year. Under the old 1961 Act, juggling a previous year for earning income and an assessment year for taxing it caused immense confusion, especially for cross-border clients. Now they share one single reference. So the financial year 2026-27 is simply called tax year 2026-27 across all your forms. Clean, simple, and efficient. To wrap up, here is your practical blueprint for Chapter IXB. Number 1, Section 159 handles bilateral relief via DTAAs, while Section 160 is your unilateral safety net. 2, Form 44 is absolutely mandatory to claim your foreign tax credit. Do not forget it. 3, use Form 42 to secure your client's tax residency certificate for outbound relief. And 4, if a foreign authority goes rogue and violates a treaty, Form 55 is your trigger to escalate the dispute via the Mutual Agreement Procedure. Look, as global mobility keeps increasing, double taxation is only going to get more complex. So I leave you with this. Are your cross-border tax strategies robust enough for the new 2025 landscape? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.